let's jump in. I want to see your interaction. I want to see you all participating here with me. So I'm going to pose questions to you all. There's a new session here. There's a poll tool that I'm going to launch in a minute. But now just go ahead and chat to me, right? Get involved, put yourself out there, put the information you're looking to get out there. Now, first thing for options on the SIE. Options as a general matter on the SIE are not that heavily tested. I like to think about the SIE testing primarily as being able to define and describe options versus calculate and do options math. So what we want to be able to do is explain what is a call, what is a put, what is the market view of each of those positions, how do they operate, what rights are they entitled to, what are the obligations that they impose upon parties, where do they trade, how are they traded, how are they priced. So understanding those fundamentals is what the SIE will test you. And if you are then moving on to the 7, it's going to then test you on application on the next exam. And so one of the areas that people frequently say to us and come back to us and say, options is the challenge. Our guidance back to you is, let's make sure we get the basics. Let's make sure we understand the essentials of options, but we don't have to become an options trader. We don't have to become a master of complex options positions to be successful on the options material in the SIE. With that, hopefully that gives you a little bit of comfort about the options material. And I want to start with the OCC, the Options Clearing Corporation. Tell me, anybody have a sense? What does the OCC do? What does the OCC do? Any thoughts on that? Open-ended questions, harder than multiple choice in some ways because you got to be able to pull it yourself. But really a great study tool because you can pull out that information as to what is, what is this entity? And this is a test point. What is the OCC? What do they do? Anybody have any sense? Transfers ownership. Yep, that's not bad. Regulates options trading. Perfect. It's a regulator of the options market. There we go. Vin's got it. That's the best one. It's the guarantee. Never spell guarantee correctly. Guarantees. They issue and guarantee options contracts. So we want you to understand that the OCC sits between the buyers and the sellers of options contracts, and they, as a middle, a middleman, ensure performance. I want you to know that that is what the OCC does. So let me ask you this: do you care who your options counterparty is? Do you care? If you buy a call, you don't care. And this is the whole point, that you don't need to do any diligence on who sells you the call. Because let me just make sure we understand. If I'm long a call, what do I have? What do I have? The option to buy, good Gabriella? The right to buy. And if I have the right to buy, it's from a seller. And that's the person who's short a call. I have the, what do I have if I'm the seller? Obligation to sell. So here's the whole thing about the OCC to tie it back together. I have the right to buy from this counterparty. But if that counterparty can't perform, the OCC will sell to me. The OCC makes sure that my right to buy is not interfered with by some short call writer not having the stock to sell me. So that's going to be the idea surrounding the OCC that I would want you to understand. Ensure performance. What do you think it does to options liquidity? What does having the OCC do to options liquidity? Up, down, or nothing. Yeah, big increase in options liquidity for the reason we just talked about. I don't care who you are on the other side of my trade, because if you're not going to be performing, the OCC will. And so the whole OCC marketplace came back, was created to say, let's make options really liquid. Bonus points. Is there a similar entity for stocks? The central counterparty. Anybody know? Anybody knows? Is there a similar entity for stocks? The OTCBB, that's a venue. There you go, Kelso. The FICC for bonds, that's the fixed income clearing corporation. And so there is, it's called the NSCC for stocks. It's called the FICC for bonds. Now, I'm not saying you need to know these, but I like for you, in this time particularly, when we're trying to flesh out the periphery, we're trying to say, you know what? We're going to master all this stuff. The central counterparty is the model. We use the OCC for options. We do NSCC for stocks. We do FICC for bonds, where we have a central counterparty standing between the actual trading entities to ensure liquidity, performance, and things like that. Great work, everybody. All right, tell me, American style. What's it mean? What does that mean? Who knows? What is an American style option? Exercise before or at a trade. Excellent. Gabriella, Bethany, Caroline, love it. You can exercise, here it is, at any time. Versus what's the alternative? What's the alternative? There are a couple, but there's only one other one for the exam. If not American, it's European, which means what? Exercise when? When are we exercising? Europeans. On expiration date, right? Just be careful terminology. We're not exercising at settlement. We're exercising on expiration date. How do you guys remember this? Exercise at any time. My way to remember it. How do you remember American means anytime? Anybody have a good way to remember that? Land of the free, right? Do whatever you want. Americans are flexible. Good. I like that. Now, here's the thing. Why would it be weird? Not impossible. Not impossible. Americans should exercise more. I love that, Amy. Americans as a general population, we need to exercise more. That's great. Why would it be weird to exercise before expiration? What do you lose? What do you lose? Anybody remember this? What do you forfeit? Yeah, you forfeit time value, Aaron. Good. You forfeit time value. So in general, it's unusual to exercise before expiration, but you can in an American style, and you cannot with a European style. Last thing, if I have a stock option, so the underlying asset is shares of stock. What do you think, American or what do you think? Stock options, American or European? Anybody know? They're American style. Good. And what for us is European style? What kind of option? Good, Caroline. Good, Vin. Index options. Give me a good index option to know for this exam. Best index option to have bought 3 to 4 weeks ago. Best index, I better clarify. Call option that I bought 3 to 4 weeks ago. Good, the VIX index. What's that measure? Colloquially, not technically. Generally, what's it measure? Fear, more technically, volatility. So tell me right now, is the VIX up or down? Not today, but over the past month. VIX is way up. So your VIX index options, call options have done very well. If you wanted to hedge your portfolio for COVID-19 fears, what could you have purchased? What kind of option could you have purchased? I saw one person said it. Kelso, what kind of option would you have purchased? S&P put option. All right, good. Good, good, good. Moving on. In the money, at the money, out of the money. Okay, tell me. If you are long an option, what do you want? If you're long an option, do you want in, at, or out? You want in the money. Does it matter, call or put? If you are short an option, what do you want? What do you want? Out of the money. Every time. Do all in the money options get exercised? Yes or no? Do all in the money options get exercised? Good, Christiana. Good, Sonny. Ooh. Yes, they do. All right, next question. Next question. Does an in the money option mean it is profitable for the long exercising party? No. What does at the money mean? Exactly, not necessarily. Right? In the money does not mean break even. All right, tell me, what does at the money mean? Strike equals current market value. Write that out. If an option, this is a little bit harder. If an option is at the money, who is most likely showing a profit on the trade? The long or short party? Good, the short party. Excellent, excellent. Okay, a couple examples real quick, because this was stuff that was showing up. ABC is trading at $45 per share. I've got one. ABC 40 call at 7. I got one. ABC 40 put at 2. Tell me, first contract, the 40 call, in the money, at the money, out of the money. It's trading at 45. So that's my market value. So it's worth right now. It's a 40 call. In the money, out of the money. What does this give me the right to do? All right, let's back up. So we're going to decide in the money, at the money, or out of the money. Okay, first question. Does it matter if we are long or short the call? Yes or no? This is key. You got to understand this. Does it matter? It doesn't matter. Moneyness, okay? Moneyness is not long or short. whether it's in the money or out of the money is a straight comparison of strike versus market. It's strike versus market. It's in the money for both the buyer and seller. It's at the money for both buyer or seller, or it's out of the money for both borrower or seller. Moneyness does not tell us good or bad. It tells us, will the option be exercised? Yes or no. Does that make sense to people? Super important point. So let me, for the buyer, is it in the money, at the money, or out of the money? In the money here. Okay, and that's because you have the right to buy stock for 40 that's worth 45. Would all of you want to buy ABC for $40 when it's worth 45? Yes or no? That's how you can test it. That's how you can test it. Would you buy ABC that's worth 45 for 40? Yes. So the option's in the money and will be exercised. Now, you're not, that thing makes a great point. You still lose money. But would you rather lose $2 or $7? Would you rather lose $200 or $700? And I assume all of you would rather lose $200 than lose $700, so you exercise. Okay, same question. For the call seller, is this option in the money, at the money, or out of the money? Good, Caroline. Good, Gabriella. Good, Olivia. It is in the money because the buyer will exercise. The strike is less than the market value. That's for calls. It is not. So this is a key point for SIE because this is definitional. You have to be able to explain when contracts are in, at, or out of the money. It is not what the investor wants, right? The call seller hopes it expires, but is this contract going to expire? The writer wants expiration, but will this contract expire? No. It's going to be exercised because the buyer has the right to purchase stock for less than what it's worth. $40 is still less than 45. The option will be exercised. The premium on this option is 7. So the question is, where did I get the $200? So you would buy at 40, sell at 45, making $5. It's all per share. But you paid $2 per share. Excuse me, you didn't pay. You paid 7 per share. So you end up down 2. Break-even point on the contract is 47. Okay, let's do it one more time with a put this time. Let's do it with a put. So you're long a put, or you're short the same put. Okay? In the money or out of the money. Everybody see why it's not at the money? Let's just do that one real quick. Okay? When is this option at the money? Market value of ABC is how much? How much? Market value of ABC is, Bethany's got it. Not below 40. It is exactly 40. This is key. Also, ATM is when the market value equals the strike. You're indifferent to exercise. Why are you indifferent? Why are you indifferent? Because you can sell stock in the market, call it NYSE at 40, or exercise and sell to the short put party at 40. See, it's the same. You don't care. All right, back up to the top, because this is important. This one's important. Know this. But that's straight definition. That's good stuff. Long a 40 put, and the ABC market value is 45. Tell me, gang, is this contract in the money, out of the money? Remember, in the money means exercise. There's value. It's better. Out of the money means no way. No way, Jose. I'm not going to exercise. All right. I'm seeing mostly out of the monies. Anybody want to take a chance at explaining why? Who can explain how they think about it? Why is it out of the money? What choice does this investor have? How would you characterize this choice? Yeah, strikes greater than market, Gabriella. It would not be exercise. Why? Perfect, Caroline. Why would you sell a stock for less, right? Choice one, exercise, sell my stock for 40. Choice two, expire, sell my stock for 45. Which one do people like? Anybody like choice one? Anybody would like choice one? Nobody likes choice one. Nobody likes choice one. And don't let the fact that you own the option contract, remember, it was an option, get the choice. You don't have to perform. And so it's out of the money. You would never do it. Now, what about this? What about this? Remember, choice one is exercise. But remember, it's not my call. It's not my choice. It's the guy above's choice. It's the long put's choice. So will the long party sell me $45 stock for only $40? Will they do that? Yes or no? No. Perfect. So it is also out of the money because it's not getting exercised. Who's happy? Who's sad here? One of these parties is happy, one is sad. The long or the short, who's happy, who's sad? The seller's happy. Remember, option sellers like out of the money. OTM, ITM, Moneyness doesn't tell us if you're happy or sad. They tell us, will it be exercised? Do people have more clarity on this point? Okay. Now, I only have a couple minutes. So we're going back to the exam. Can people now see the screen with the test prep question? Can you read it? Is the font big enough? Okay, I may go over 5 minutes because I really want to spend 5 to 10 minutes doing this with you all. I'm going to put up a poll here. I don't know how this works, to tell you the truth. So I just launched a poll. Sharing poll results. Can anybody see the poll? It's closed. 0 voted. I gave you guys less than 1 second. So can folks see the poll with the 4 choices that you could put in? Oh, so it takes over your whole screen. It takes over your whole screen, which makes it really hard to answer the question. Gotcha. Okay. All right. So let's let me see. Okay. So take a look here, and I want just chat me the answer that you like, A, B, C, or D, regarding Treasury securities, A, B, C, or D. Again, a couple C's. Uniformly seeing C's as the good answer. All right, so here it is, gang. This is it. This is how you get the most out of each of these questions. So you pick the right answer, or maybe you didn't pick the right answer. It doesn't matter. What you now need to be able to do is explain why treasuries do not carry credit risk. Right? So you would want to be able to say, all right, so you're doing the question, and you can do this because some of you are going to have a lot of time. Now, I know others are not, but many of you are going to have more time to prep than you might have originally anticipated. So sometimes what I'll do when I'm working with students one-on-one is I'll grab a question like this and I'll say, all right, we're going to do a deep dive on it. So let's make sure we really understand this question. And you'd be doing this on your own, so you don't have to like display it, but I want you to see what I would do with you. So no credit risk. You'd say, all right, why not? Why don't treasuries have credit risk? And you'd want to be able to answer that because the US government can't default, because they can just print or create more money to make the interest and principal payments. You now can explain, if you were able to say that, you can now explain why we don't consider US treasuries to have default risk. Imagine if you had a debt obligation, but you also controlled the generation of the cash. I owe somebody $1,000. I don't have $1,000. That's all right. Let's just print more money and then we give it out. Now, maybe you press on. Maybe you press on. You say, oh, that's kind of interesting, but what happens if the government just prints more money? What happens? What's a concern? What's a risk here? Anybody have a risk? Yeah, inflation, or what do we call it? Purchasing power risk. And then, right, that's later in the question, that's here. So here's our credit risk. So we grab that, and then we talk about, we make sure we understand it. Then we say, oh, purchasing power risk, that's interesting. That's actually the question here. Let me make sure that I can speak to that. And we say, what is that risk? Who knows? Who can explain what is purchasing power risk? What is inflationary risk? And we are at the end of the time. You have to drop off. I totally understand. Thank you for coming. I'm going to push on for just 5 more minutes or so and show you again what I'm trying to do with these questions. Yeah, how much goods you can buy with it. It's your buying power, right? Those $1,000 the US government gives you back because they printed lots of money, everybody got it, buys less stuff. Did anybody see that if everybody in the United States gets $1,200 in the check right now, that maybe prices could go up? Could happen. Could be a concern. If everybody just gets more money, vendors, retailers, sellers are going to raise the prices because everybody has more money, which means that your money actually doesn't go as far. You might say, oh, that's interesting. They also talked about interest rate risk. What's that? Yeah, it's that the value, the price of my bonds will change as new bonds come to market with higher or lower coupons. Could a treasury, a US government security, have a change in price? Absolutely. Right? So if we see, as we are now, new bonds coming to market with lower interest rates, what is happening to the price of existing bonds? What would you expect? They're going up because investors prefer and therefore buy, driving price up, those older bonds that have higher coupons. Good. And so what you've done here is taken one question, and we've only done one answer, the right answer, and we unpacked it. We said, I didn't just pick C and move right on. We spent 7 or 8 minutes. How long have we been on this question? 6 minutes, making sure we not only could identify that they don't have credit risk, but they do have purchasing power and interest rate risk, but that we understand what credit risk is and what it would apply to. And you could spin it off in all kinds of ways. You might ask, do munis have credit risk? Yes or no? You'd say yes, but not that much. And you might say, do munis get insurance? You'd say, yeah, they actually can get insurance to back that credit risk. You'd say, what about corporate bonds? Do they have credit risk? And you'd say, yeah, corporate bonds have credit risk because if they go bankrupt, they're not going to repay their lenders. We talked about purchasing power risk. We talked about how do you mitigate some of that risk? How can you get variable investments versus fixed investments? We talked about interest rate risk and how that could impact the price of an instrument, although the coupon stream won't change. And then I would invite you, you're not done yet. We're not done with the question. To look at these wrong answer choices and identify what's wrong about it. Right? Now, sometimes there's not that much to do. Like A here says it's subject to credit risk, and well, we just explained why that's not the case. Right? And they do have purchasing power risk. So A, you'd say, well, they just kind of misdid it. But B is a chance. B is an opportunity. Are subject to all the same risks as any other fixed income security. So you know what? Why don't I take this chance? So if I was sitting with you one-on-one working, I'd say, all right, do a little compare and contrast. Do a little compare and contrast for me, right? How do govies compare to munis versus corporates versus whatever other fixed income products come to mind? Those are my main 3. And have you begin to talk about the characteristics of each of them. And here's the thing, if you can't, you can go back to the textbook, you know it's drawing out of Unit 2, and you can read up on it, or you can go back to lecture notes to see what you can flesh out. This is the game you play when you're trying to get the most value out of the questions and you have the time. So as I wrap up here, I see a couple questions: how interest rate risk differs from reinvestment risk, and what doesn't have interest rate risk. I'll answer those two questions and then we will wrap. So reinvestment risk is that you cannot, what can't you do? Reinvest, typically coupons, at the same rate of return. All right. So is this about, so what describes the risk that your bonds price will change? When we talk risk, it's primarily down, but it is not down necessarily. It could go up or down. What describes the risk? We've got a bunch of risks here. We just talked about a bunch of risks. Good. This is interest rate risk. Notice how that is different, your bond's price changing, from reinvestment risk. When do you face this? Rates are which way? Down. When do you face this most prevalently? Rates are up. Good, Ben. And tips. Right, so right in here, you'd say, how do I avoid it? Not inflation. Where's purchasing power? Here. Tips. Adjust. So my purchasing power stays the same. All right. With that, gang, I apologize for going over, but thank you for staying with me, for many of you. If this was useful, let me know. You're going to get a quick survey from us. Tell me, platform good? Was the communication clear? Did you like the style? If you could change one thing or more things, let me know. I am open to serving you however I can, and will do so on an ongoing basis. We're going to be exploring different platforms over the next couple of weeks, figure out what works best for people. So look for an email from me or our support team inviting you to sign up for the next time. We'll have more capacity, so it won't be crunched, but of course all of you got in, but you might be aware that that was a concern. And like I said, we'll be emailing this out later today with the document I created, that we created, and the recording, and we'll get that out to you as soon as we can. With that, have a great day. Thank you all for your attention, your focus, your participation. It's fun, and I hope you learned some stuff. With that, be well, stay positive, focus forward, and I will talk to you all again next week. Bye-bye.